Something just happened in the silver market that almost nobody is talking about, and it could change how silver is priced permanently. After being closed for 9 full days during the Lunar New Year holiday, the Shanghai Gold Exchange reopened, and within seconds of reopening, it exposed a massive gap between paper silver and physical silver. Shanghai opened at $88.24 per ounce. At the exact same moment, Western spot silver was trading around $78.86. That is a difference of $9.38 per ounce, nearly a 12% premium. Not 2%, not 3%, 12%. That is not normal. In a balanced market, physical silver in Shanghai typically trades only $2 to $5 above Western spot. That small premium reflects shipping costs, regional demand, and logistics. But nearly $10? That is not logistics. That is stress, that is urgency. That is physical buyers paying whatever price is necessary to secure real metal. And the timing makes this even more important, because while Shanghai was closed, Western paper markets crashed silver aggressively. On February 17th, silver fell all the way down to $72.62 per ounce. A sharp drop, fast, violent. It happened during thin liquidity, when fewer participants were active, when price can move more easily, when paper contracts can push price further than physical reality might justify. And during that entire crash, China was offline. The largest physical silver buyer in the world was not participating. But the moment Shanghai reopened, the price snapped higher immediately, not gradually, immediately. And it snapped higher by nearly $10 relative to Western spot. That tells you something critical. The physical market did not agree with the paper crash. It rejected it. Because when real buyers returned, they paid significantly more. Not because they wanted to, but because they had to. Because physical demand was waiting. Because supply was limited. Because industry still needed silver. Solar manufacturers, electronics producers, electric vehicle companies, medical device manufacturers. All of them require physical silver, not paper, not futures contracts, metal. And when the exchange reopened, those buyers stepped in, and price reflected their urgency. This is how real markets work. Paper markets can move quickly. They can react to headlines, algorithms, speculation. But physical markets move based on necessity, based on real demand, based on real supply. And right now, physical demand is showing strength. Now here's where things become even more serious. Because Shanghai's reopening did not happen in isolation. It happened just 72 hours before one of the most important deadlines in the silver futures market. COMEX First Notice Day. First Notice Day is the moment when traders holding short contracts must declare whether they will deliver physical silver or settle in other ways. This is when paper contracts face reality, because every contract represents 5,000 ounces of silver, and someone, somewhere, must provide that silver if delivery is demanded. Right now, COMEX reports approximately 88 million ounces of registered silver inventory. Registered inventory means metal that is actually available for delivery. Not theoretical supply, not underground reserves, not future production, metal sitting in vaults, ready to be delivered. Just 4 months ago, that number was significantly higher. Inventory has declined sharply, and it continues declining. At the same time, the amount of silver represented by futures contracts is far larger. March open interest represents somewhere between 230 million and 358 million ounces of silver. That means paper claims exceed physical supply by a multiple, between roughly 4 to 6 times more claims than available metal. This structure only works under one assumption, that most contract holders will not request delivery. They will roll contracts forward, they will close positions, they will settle financially. Because if too many participants request physical silver at the same time, inventory falls rapidly, and that brings us back to Shanghai. Because Shanghai just raised the incentive to take delivery. If physical silver in Shanghai trades near $88, and futures contracts allow delivery at lower prices, participants suddenly have a reason to demand metal, not later, now. Because rolling forward introduces risk that price rises, risk that supply tightens, risk that premiums expand further. Delivery removes that uncertainty. Delivery guarantees supply, and that is why the next 72 hours matter more than most people realize. Because the decisions made during this window will determine whether inventory declines gradually or rapidly, whether the system stabilizes or enters stress, and whether paper prices continue leading the market or begin following physical reality. In part 2, we'll break down the exact delivery scenarios. What happens if 20 million ounces are demanded? What happens if 50 million ounces are demanded? And what happens if demand exceeds available inventory entirely? Because the math is simple, and the implications are enormous. Now, let's talk about the numbers that could decide what happens next. because every silver futures contract represents 5,000 ounces of physical silver. That means if 4,000 contracts stand for delivery, that equals 20 million ounces. If 10,000 contracts stand for delivery, that equals 50 million ounces. And if 16,000 contracts or more stand for delivery, that equals 80 million ounces or more. Remember, COMEX currently has around 88 million ounces of registered silver available. That means the margin for error is extremely thin. Let's walk through the scenarios. The first scenario is the most stable outcome, an orderly rollover. In this case, most traders close their positions or move them into future months. Delivery demand stays below 20 million ounces. Inventory declines, but remains intact. COMEX survives. The system continues functioning normally. This is the lowest stress outcome, but it is no longer guaranteed, because physical incentives have changed. Shanghai just showed the world that real silver is worth significantly more than Western paper, and that changes behavior. The second scenario is system stress. This is the base case scenario many analysts are watching closely. If around 10,000 contracts stand for delivery, that means 50 million ounces must leave COMEX vaults. Inventory would drop from around 88 million ounces to roughly 37 million ounces. That is a massive reduction, nearly half the remaining supply gone in one delivery cycle. That kind of decline sends a signal to the entire market. It tells participants that supply is tightening fast. It increases urgency. It increases competition for available metal. And when urgency increases, price responds. Because price is the mechanism markets use to ration scarce resources. In that environment, silver does not drift higher slowly. It moves faster, more aggressively, toward price levels that slow demand and attract new supply. That's when you begin seeing prices move toward the $95 to $110 range. Not because of speculation, but because inventory math forces repricing. The third scenario is the most extreme and the most disruptive. If 16,000 contracts or more stand for delivery, that means 80 million ounces or more would be demanded. That would nearly equal total registered inventory. At that point, the system faces a structural problem, because exchanges rely on confidence. Confidence that contracts can be fulfilled. Confidence that delivery is possible. Confidence that supply exists. If delivery demand approaches available inventory, participants begin adjusting behavior immediately. Some shorts rush to close positions. Some buyers refuse to sell. Some participants demand higher premiums. Liquidity tightens, volatility increases, and price moves quickly, because markets adjust faster than supply chains. Supply cannot instantly increase. Mining takes years. Refining takes time. Transportation takes time. But price adjusts instantly. That is how markets restore balance. Now here is where Shanghai's premium becomes critical, because Shanghai has already established a physical reference point. Physical silver trading near $88. That creates a floor. Industrial buyers understand this. If they need silver for manufacturing, they must secure it. They cannot wait indefinitely. They cannot pause production lines. They cannot delay solar panel manufacturing. They cannot delay electronics production. Silver is not optional for these industries. It is essential. So when futures contracts allow delivery near or below that level, some participants will choose certainty. They will choose delivery. They will choose metal, not paper. And every ounce delivered reduces exchange inventory further, which increases pressure on the remaining supply. This is how delivery cycles can reinforce themselves, not through panic, but through rational decisions, through math, through incentives. And we are already seeing signs of a structural shift. Major corporations are locking in supply directly. Mining output is being contracted years in advance. Long-term purchase agreements are increasing, because large buyers do not want to depend entirely on exchange inventory. They want security. They want predictability. They want guaranteed supply. This reduces the amount of silver available to exchanges. And over time, it strengthens the influence of the physical market relative to the paper market. This exact pattern has happened before. During previous commodity shortages, physical premiums appeared first, then inventory declined, then paper prices adjusted upward to match physical reality. Because paper cannot override supply and demand forever, eventually, price must reflect scarcity. Now, over the next 72 hours, there are several signals that matter more than anything else. First, open interest. If open interest declines significantly, it means traders are rolling contracts forward. That reduces immediate delivery pressure. If open interest remains high, it means delivery demand could increase. Second, lease rates. Silver lease rates normally stay between 1% and 3%. If lease rates rise sharply, it indicates growing demand for physical metal and tightening availability. Third, Shanghai's premium. If the premium widens further, it confirms strong physical demand. If it narrows, it suggests temporary balance. And finally, delivery notices. When delivery data is released, It will show exactly how many ounces are being requested. Not speculation, not predictions. Reality. Because contracts multiplied by 5,000 ounces each reveal the total demand, and that number will tell the story clearly. The most important thing to understand is this. Shanghai's reopening did more than move price. It revealed the difference between paper valuation and physical valuation, between theoretical supply and available supply, between financial positioning and industrial necessity. A nearly $10 premium is not a normal fluctuation. It is a signal that physical demand is active, a signal that inventory matters, a signal that delivery cycles matter, and a signal that the relationship between paper and physical silver is being tested. Over the coming days, the market will decide how that gap closes, whether paper prices rise toward physical, whether physical premiums stabilize, or whether volatility increases further. Because when physical demand and paper supply diverge, eventually, they converge again, and the direction of that convergence is what the entire market is watching right now.